Imagine an investor whose returns make Warren Buffett's legendary performance look almost ordinary. While Buffett, the Oracle of Omaha, has averaged an incredible 20.1% annual return, another man quietly achieved something far more staggering. Peter Lynch delivered 29.2%, Ray Dalio and George Soros both sit around 20%. But then there is Jim Simons. His flagship Medallion fund has produced an average annual return of 66% over more than 3 decades. Long before he ever placed a trade, Jim Simons was captivated by mathematics. He was a prodigy. He earned a bachelor's in math from MIT, completed his PhD at UC Berkeley by 23. During the Cold War, he worked as a codebreaker for the National Security Agency. He used math to decipher secret messages and find hidden patterns. After codebreaking, he returned to academia, chairing the math department at Stony Brook University. But he felt a new calling. He wanted to apply his analytical mind to the financial markets. In 1978, he founded a firm that became Renaissance Technologies. He believed code-breaking principles could be applied to financial data. Encrypted messages had hidden patterns, so did market prices. At a time when trading relied on intuition and fundamentals, this was radical. His premise was simple and revolutionary. Human emotions, stories, and biases were unreliable guides for investing. The only thing that mattered was the data. He pioneered quantitative analysis, using mathematical models to trade. He only cared what historical price and volume data showed. He hunted for statistically significant repeatable patterns. Tiny signals that, traded thousands of times, could produce enormous profits. He was trying to find the market's secret code. That background set him apart from other investors. While others sought Wall Street wisdom, Simons recruited people who'd never read an earnings report. He sought mathematicians, physicists, astronomers, computer scientists. You can teach a physicist finance, but you can't teach a finance person physics. That philosophy became the cornerstone of his empire. He wasn't building a traditional investment firm, he was building a scientific research laboratory to crack the market's code. If you had invested $100 in 1988 and achieved 66% returns annually, by 2019, that would be worth over $665 million. This isn't just beating the market, it's rewriting the rules of what's possible. His firm became a black box of financial wizardry, where PhD mathematicians and scientists, not MBA graduates, were the stars. They didn't care why a stock moved, they only cared that their models could predict that it would. This is the story of how a man who loved numbers more than money used his unique genius to solve the market and become the most successful investor in modern history. These are his 7 strategies. When Simons first entered finance in the late 70s, the sophisticated models he's famous for didn't exist. Like many traders, he began using conventional methods. He relied on fundamental analysis, evaluating company health, and technical analysis, using charts to predict price movements. For the first few years, he operated like any discretionary trader, making decisions based on intelligence, intuition, and economic principles. By all accounts, he was quite successful, turning handsome profits. However, despite early success, Simons found the experience emotionally taxing. He would feel like a genius after profitable trades, only to feel like a fool when markets moved against him. The process left him vulnerable to psychological highs and lows that plague human traders. Simons yearned for a system like a casino. The house doesn't get emotional about winning streaks. Over thousands of spins, the mathematical advantage guarantees profit. The house just needs people to keep playing. Simons wanted to build a similar house for the stock market. Strategy 1. Massive data collection. Simons and his team embarked on gathering every piece of financial information possible. Historical prices, trading volumes, annual reports, economic announcements, even weather patterns. They amassed terabytes daily, creating one of the most comprehensive financial databases. For quantitative analysts, data is the raw material from which profits are extracted. The team sifted through this ocean of information, looking for anomalies. An anomaly was any small, statistically significant pattern that repeated over time. The key was they didn't care why the anomaly existed. For example, retail stocks consistently rising before Christmas, then falling after. Simons' team didn't need the story, they only needed data confirmation. They programmed computers to automatically buy and sell, capturing predictable profits. Strategy 2. Trend following. Once a price starts moving in a direction, it often continues, like Newton's law of motion. This worked particularly well in commodities: gold, oil, copper, corn, wheat. The system might analyze wheat prices over 20 days, detecting consistent upward movement. If trending up, it would automatically buy wheat futures. If trending down, the system would short sell. This trend-following system was highly effective in early quantitative trading. A simple model could identify trends, ride the wave, and exit when weakened. As time went on, other traders started catching on. More computers entered the market hunting the same trends. Competition made trends shorter and less reliable, alpha decay. So Simon's team had to evolve, building far more complex models to keep their edge. Strategy 3. Mean reversion. Prices that move away from their average tend to snap back, like a rubber band. A stock might temporarily spike up or crash down, but often reverts to stable average. The team built sophisticated models analyzing hundreds of data points simultaneously. For example, Apple's price-to-tangible book ratio typically hovered around 43. When it dipped to 38 or spiked to 48, the model recognized opportunities. The system automatically bought when below average, shorted when above. Each trade targeted tiny inefficiencies, like flipping slightly bent coins. Flip thousands and you build a fortune. By finding thousands of fleeting opportunities and trading at lightning speed, Renaissance generated consistent profits from market inefficiencies invisible to humans. These first three strategies, data collection, trend following, and mean reversion, became the foundation of Medallion's early success. But Simon's was just getting started. The most powerful strategies were yet to come. Strategy 4. Machine learning and complex models. As markets grew more competitive, simple models would no longer suffice. Renaissance began constructing extraordinarily complex multi-factor models incorporating machine learning. Just as a chess computer analyzes millions of past games to learn winning strategies, Renaissance's machines analyzed petabytes of market data to discover profitable signals invisible to humans. These models ingested thousands of data points for every stock all at once. The system correlated everything: price fluctuations, trading volumes, corporate announcements, currency movements, news sentiment. It used machine learning to find intricate, non-linear relationships hidden within massive datasets. The goal was forecasting price movement seconds or minutes into the future. As Simons explained, you test theories on the computer. Maybe they work, maybe they don't. The beauty of machines is testing a million theories in the time humans test one. The result was a monolithic trading engine, a black box finding patterns no human ever could. Strategy 5. Hiring brilliant scientists, not Wall Street traders. Simons understood a fundamental truth. To solve the hardest problems, you need the smartest people. He avoided typical Wall Street talent, believing their minds were conditioned by traditional thinking. Instead, he looked to academia, searching the nation's top universities. He hired PhDs in physics, astronomy, statistics, computational linguistics. They'd spent careers solving complex problems, modeling galaxies, decoding human language. You can teach a physicist finance, but you can't teach a finance person physics. They treated the market not as stories, but as a massive data set to analyze. Simons didn't just hire employees, he made them partners. Ownership in Medallion required working at Renaissance, creating powerful incentive alignment. Every scientist, programmer, and researcher was personally invested in the fund's success. This aligned everyone's interests to a single goal: making money by cracking the market's code. It built a culture of intellectual collaboration and fierce competition against the market. Hundreds of genius-level intellects motivated by scientific curiosity and financial reward worked together to solve one gigantic puzzle. They were the Avengers of quantitative finance, each bringing a superpower: statistics, coding, theoretical physics. This concentration of brainpower, focused and incentivized as partners, was Simons's greatest competitive advantage. Strategy 6. Strategic use of leverage. The models were effective, but individual signals often predicted very small profits. To transform modest returns into spectacular 66% annual averages, Renaissance used leverage, sometimes borrowing $17 for every $1 of their own capital. That sounds incredibly risky. For typical investors, it could mean financial ruin. But Renaissance was different. Their confidence in their models was extreme. Unlevered, their models made modest returns with very low volatility. Leverage turned those modest, stable returns into something extraordinary. The safety depended on high probability correctness across massive trade counts. It was like putting high-octane returns on steroids, safely administered by cold, calculating algorithms. Their system was statistically robust enough to bet the farm repeatedly. Strategy 7. The 8,000 signal system. During the mid-1980s, Simons's team began identifying ghost patterns in market prices. The project was based on similar code cracking work from the National Security Agency. The Medallion fund featured a collection of minimum 8,000 signals based on short-term patterns. The fund leveraged these signals, borrowing money to trade countless times per day. Thousands of tiny high-probability edges plus massive controlled leverage created a financial engine that didn't just beat the market, it left it behind. These 7 strategies secured Jim Simons' legacy as the quantitative king and the most successful investor in modern history. By combining all 7 strategies, Jim Simons created the ultimate money-making machine. Massive data collection, trend following, mean reversion, machine learning, brilliant scientists, strategic leverage, and thousands of signals working together as a single, integrated system. A dynamic, self-improving money-making machine processing information at inhuman scale and speed. The results speak for themselves: 66% average annual returns over 31 years, turning $100 into $665 million, a feat unmatched in investment history. Simons proved that with enough brainpower and computational might, the market could be systematically beaten. He ushered in a new era of investing driven by algorithms, computers, and pure data. His approach transformed the entire financial industry, inspiring countless quantitative funds. He showed that mathematics could unlock the market's deepest secrets. Today, PhD mathematicians and scientists continue to follow his blueprint. Jim Simons proved that the greatest investment strategy isn't about understanding businesses or predicting trends, it's about finding patterns in data that others cannot see. By applying the scientific method to financial markets, removing human emotion and bias, and letting machines do what they do best, process vast amounts of information, Simons achieved what many thought impossible, consistently beating the market by enormous margins. These 7 strategies, data mastery, trend following, mean reversion, machine learning, genius recruitment, strategic leverage, and signal multiplication, created the greatest investment success story ever told. Jim Simons, the mathematician who solved the market and became the most successful investor in history.